My name is Kevin Smith. I'm a research activist with Carbon Trade Watch, which is a project of the Transnational Institute. Carbon trading is supposedly a means of making emissions reductions in the most cost-effective way possible. That is, if it's cheaper to reduce emissions over in India, for example, than doing it in England, you can buy the emissions reduction in India to justify pollution in England. One of the biggest problems of carbon trading is that it doesn't have any track record of having ever performed effectively in comparison to more traditional regulatory mechanisms. People use the example of sulfur dioxide trading in the States as being the big success story of emissions trading that's justified our current enthusiasm for carbon trading. But if you compare America, which over the course of a 20-year program of sulfur dioxide pollution trading is supposed to have reduced its sulfur dioxide emissions by 35%. You compare that with Germany, which in a similar 20-year period has reduced its sulfur dioxide emissions by 90%. So it hasn't been that effective in comparison to the regulatory system of Germany, which didn't use any market-based mechanisms whatsoever. The fact is, carbon trading has been chosen as the main policy response to climate change because of its compatibility with the economic agenda of privatization and the idea of the omnipotence of the market. These ideas have been very politically fashionable over the previous decades. It hasn't been chosen because of any track record of ever having reduced emissions effectively, because there isn't one. The experience of emissions trading so far, the biggest example has been the EU emissions trading scheme. And over the course of that trading scheme, emissions covered by the scheme have actually increased. At the same time, we've seen enormous windfall profits being made by some of Europe's biggest polluters. Over the course of the first phase of the European emissions trading scheme, the four biggest energy companies made windfall profits of 6 to 8 billion euros out of the carbon trading scheme. It's running on the principle of polluter profits rather than polluter pays. One of the main problems with these market-based mechanisms is their inherent vulnerability to corporate influence. When a market's been designed to meet a political end rather than meeting a human need, it's a lot more vulnerable to corporations influencing it to their own self-interest. And this has happened at every step of the design and implementation of the EU emissions trading scheme. So instead of corporations having to take measures to affect the way they change their structure, they change their means of production, they're being provided opportunities not only to avoid making those changes, but actually to play the game, to game the system and actually make large profits out of it. There's so much evidence and so many reports that tell us that the longer we delay the transition from happening to a low-carbon economy, the more difficult it's going to be, the more expensive it's going to be, and the more problems we're going to suffer as a result of runaway climate change. So it's just a craziness that in the face of that knowledge, what we've done is we've designed a system whose intention it is to delay those changes from happening. Rather than making those changes here and now as individuals, as communities, as a country, as industry, we're enshrining a system that's sanctioning further increased fossil fuel consumption and extraction. We're providing a means, a legitimized means for companies and people to avoid making those changes, to delay it. So it's just completely nonsensical in terms of what needs to be done. We're providing an opportunity for people to avoid doing that.